Retiree Budget, how to plan for inflation. Have you ever wondered how inflation can impact your retirement budget? It can be a real challenge as prices for everyday items continue to rise. Understanding how to manage these changes is key to maintaining your purchasing power. Let's break down some practical steps to help you plan for inflation effectively. First, it is essential to grasp how inflation affects your budget. Inflation reduces the value of money over time. For instance, a 3% annual inflation rate can nearly halve your purchasing power in just 20 years. This means that your everyday expenses, especially for essentials like housing, healthcare, and food, will likely increase. Next, create and maintain a detailed retirement budget. Separate your essential expenses from discretionary ones. Essentials include housing, healthcare, food, and transportation, while discretionary expenses cover travel and entertainment. Prioritize your essential needs and monitor your spending regularly. This will allow you to adjust for any inflation-driven increases. Using retirement budget templates can help you track and plan these changes systematically. Building an emergency fund is another smart move. Set aside liquid savings for unexpected expenses. This way, you won't have to dip into long-term investments or increase your debt when inflation-related surprises arise, such as sudden healthcare costs or home repairs. Consider diversifying your investment portfolio with inflation-resistant assets. Investing in stocks, real estate, commodities like gold, and inflation-protected bonds can help your savings grow. These investments can provide income that adjusts with rising prices, keeping your finances in check. Avoid overly conservative portfolios that may not keep up with inflation over time. When it comes to withdrawing from your retirement savings, think about strategies that adjust for inflation. One approach is the dollar-plus inflation method, which increases your annual withdrawals based on the inflation rate. This helps maintain your purchasing power year after year. Alternatively, a percentage of portfolio withdrawal method adjusts your spending according to market performance, but it requires flexibility in your budget. Also, consider income sources that adjust for inflation. Look into annuities or Social Security claiming strategies that increase your income with inflation. For example, delaying your Social Security benefits can lead to higher monthly payments, which may better keep pace with rising costs. Some annuities even offer inflation riders that adjust payouts over time. Regularly reviewing and adjusting your plan is vital. Inflation rates and economic conditions can change, so revisit your budget, investments, and withdrawal plans periodically. Make adjustments to your savings, spending, and asset allocation as needed to stay aligned with your financial goals and inflation trends. Lastly, seeking professional financial advice can be beneficial. A financial advisor can help tailor your retirement plan to include strategies that protect against inflation. They can assist in optimizing your portfolio, timing your Social Security benefits, and managing withdrawals to reduce the risk of outliving your savings. By combining a well-structured budget with diversified investments and flexible income strategies, you can better manage the impact of inflation on your finances. This approach will help you maintain financial stability throughout your retirement.